So welcome to our second panel, Diana, David and Nick. And we'll be talking about changing world, market trends and their impact. So we're going to start with a question for Diana.
Okay, this is a very chatty group.
We're having so much fun.
Yeah.
It's safe to say there's been a long period of uncertainty with stagflation rife, events across the globe causing issues in many sectors. How has the world of private and investment advisory tackled these issues to maintain a solid footing?
Well, you're right. It definitely has been a few challenging years. I think we can all agree. And not only the things that you mentioned in terms of the pandemic and war, but we've actually seen a real regime change in monetary policy, the role of central banks and fiscal policy, and the role of governments, which has had a big impact on investments. And I think people in 2022 saw for the first time a situation in which bonds and fixed income did not behave as it was supposed to. So at JP Morgan, what we try to do is work with our clients and establish financial goals and plans that we put in place, and that will help them achieve those goals, which sounds like super easy, except that people don't always stick to their plans. So what we have found in the past couple of years is the most important thing is to remind people of what the plan is. And we have a number of digital tools that we use in terms of stress testing and really making sure that people aren't veering off course. And then we spend a lot more time talking to them. So I think it's a combination of, on the one hand, client centricity and spending more time with clients one-on-one, and then using a lot of digital tools and advancements that we have in order to scale that.
Nick, is this something you've got experience of too?
Yeah, I mean, Cambridge Associates is 50 years old. We're a global business. We've been advising private clients for over 40 years. I think the first thing as our job as advisors is really to create that framework, which is kind of what you alluded to. And I think, the essence of what we're trying to do is to remove the emotional decision-making particularly from investments. And what we shouldn't be surprised about is that the fact that there are these events that continually happen decade on decade. So if you rewind, 50 years, we had very high inflation, super high interest rates in the 70s. In the 80s, we had a little blip, which was the US savings and loans crisis that many people probably wouldn't even register on your radars right now. But 1,000 institutions went out of business, and $124 billion of US taxpayer money went into bailing out a lot of people. In the 90s, we had the Asian financial crisis, the Russian debt crisis. I could go on and on and on. And so these things shouldn't come as a surprise. But at the end of the day, we're all emotional human beings. And so when you're trying to implement an investment solution, it's very difficult for any type of client, but particularly for family clients, to remove that emotional decision making. And I think the essence of our job is to do that. And so the way we do that at Cambridge is to create these frameworks, create long-term goals, which you can be nimble around. But I think working within that framework, I think is a very sensible approach, because there will be another crisis and another crisis, and we need to look beyond those into the medium term to try and smooth out the landscape a little bit.
Diana, what particular global issue do you think affects high net worth individuals most, or troubles them the most?
So what we've seen in the past, I think, 2-3 years is just an increase in concern about global dislocation and the lack of consensus as to how to cope with those things. So if you think about the pandemic, I mean, one of the things that was, I think, quite alarming to everybody was really the lack of the cohesion and answers that the world was able to provide. And the same thing, really thinking about climate change and some of the results of that. So we have a series of problems that are confronting people, like be it humanitarian level with immigration and migration problems. And all of this, I think, is creating something that we've been talking about with families, is that they are becoming more multi-jurisdictional. And part of that is intentional, because they actually want to diversify their risk by thinking about ways that they can put money in different places with providers. So at JP Morgan, what we find is we're viewed as a safe haven. So that's probably a bit like Guernsey, viewed as a safe haven. And so we're actually seeing clients come to us more and more for that kind of advice.
Okay. Nick, following on from that, what trends are Cambridge Associates finding currently? What trends do you expect to become prevalent looking forward?
Yeah, I mean, the trends have changed because the regime has changed, which is what Diana alluded to, right? We've had 15 years of zero interest rates where huge amounts of liquidity have been pumped into the markets, and the right thing to be from an investment point of view was to be invested passively in the US stock market, probably with an overweight to tech, and you'll have done super, super well.
Didn't do badly this year either.
Right. The good thing about these crises that we've touched on is that it also creates opportunity and new trends. So some of the trends that we've seen clients focus on more recently is private credit, for example, where you're getting a premium above a 5% base rate, and so on an unlevered basis you're getting double-digit returns, which was near impossible prior to that. With a bit more volatility in the markets, a bit more dispersion between good companies and bad companies, I think hedge funds have come back into vogue. I know it can be a bit of a dirty word, particularly for trustees sometimes, but we're definitely seeing more interest in hedge funds, and hedge funds doesn't necessarily mean more risk. You can have some quite conservative strategies that are hedge fund related. Private equity has seen, particularly venture capital, has seen big headwinds in recent months, given where interest rates are and the cost of capital going up. But our advice there is to keep investing in these asset classes and be consistent in your asset allocation approach, because over the medium term that will pay off. And then the last thing that I perhaps touch on is AI. Huge theme that has been on lots of people's agenda. The real difficulty within AI is how to play it, and that's most recently been kind of priced into the US tech market, but it's going to be way more disruptive than just in the tech space. So those are just 4 themes that are top of families' minds that when the conversations we're having.
David, on the personal pension side, how does the industry look to manage those risks for private individuals?
Yeah, I think that's no different from what the guys have said in terms of the investment risk, but obviously with pensions there's an additional dimension, which is that the pension fund is to be used to provide an income in retirement, and that's why historically pensions have been very tax efficient, because governments are encouraging people to save for their retirement rather than relying on the state. So with the pension fund you have to have a trustee in place, or a board of trustees, or a board of protectors in place, and they are typically sort of wise, well-educated, very experienced individuals. And they have a number of roles, really. One is sometimes to protect the member from themselves, the pension member from themselves in a personal pension. Nick referred to the sort of emotion, and often we come across people who are successful business owners, and they have some money in their pension, and they don't separate the two. They won't segregate the two, so they want to access money from the pension to help the business, and the pension trustee has to step in and say, well, no, that's for your retirement, so we have to look after that and make sure that it's invested for your retirement. There are some structures, self-administered schemes, QNUPs, which are qualified non-UK pensions, which is something which Guernsey providers do provide. And they allow a little bit more investment flexibility, so they allow the trustees to balance between the need for long-term retirement, but also allowing some flexibility to allow the pension to be invested into the business if appropriate. Okay? Yeah, and then
I think you're mine. Any of them are? Oh no, mine is.
Sorry. Thank you.
Thanks.
Yeah, so there's a balance between the two, between the business and between the long term. And then sort of more generally, the trustees are responsible for making sure that the assets, the pension, is invested responsibly. So they have to look at the client's investment risk profile, whether that changes as they get older. So younger people will have, when they're in the accumulation phase, might have a quite aggressive investment risk profile. But as they get older and they get towards retirement, they're in that capital protection phase, and so their investment risk profile changes. Have they got any sort of environmental wishes that they want to be taken into account to protect the environment? That's become more relevant in the last couple of years. And as they approach retirement, they need more liquidity within the investment. But often what the pension trustees will do is simplistically, is involve other experts. So they'll involve Dinah, and they'll involve Nick, and outsource the investment management to them. But that's fulfilling their responsibility by making sure the investments are being managed in a responsible way.
Mm-hmm. And looking more broadly than pensions, when looking at financial landscape, what opportunities do you, David, what do you see in terms of opportunities to navigate these times by looking at different jurisdictions? domiciling wealth in different jurisdictions like Guernsey, for example?
Yeah, well, Guernsey is a good example. I mean, in my role, I do work with lots of different jurisdictions, so I can be fairly objective about it. And obviously, like anything else, the jurisdiction that's used depends on the particular client, the client's objectives. But in this very, uncertain world, we need some certainty. And I think Guernsey can provide political stability, it provides economic stability. It's got a very strong Standard & Poor rating. There's several hundred financial companies in Guernsey, so you've got some choice. But importantly, when you're looking at geographical mobility, a lot of those companies in Guernsey are subsidiaries of multinationals. So if your client is in one jurisdiction, but then moves to another jurisdiction, a lot of the Guernsey companies will have offices in a number of those jurisdictions. So they're able to move with the client from one jurisdiction to another. And you get that gateway through Guernsey, I think. And then the other thing that's important, Diana and I were discussing it earlier, is the fact that Guernsey is OECD whitelisted and is very observant and cognizant of the regulatory regimes around the world. And Dan said to me, the last thing we want to do is advise our clients, recommend our clients to invest into a jurisdiction which is not following those regulations. The regulations can be quite onerous sometimes, but they are all there to protect the client. And if you were to go into a less certain jurisdiction which wasn't following the sort of regulatory changes and the increasing regulatory changes, and then in 5 years, 10 years' time, the jurisdiction was put onto a grey list, then that would cause the client issues. You'd have to undo all of those investments, all of those structures that have been put in place. So you've got to look at the current state and also look going forward as well to make sure that into the future things are going to remain stable. And I think Guernsey can provide that.
It's great to hear you talk about all the positives about Guernsey, and you didn't mention tax, which is good, and that's following on from a point on the previous panel that it's not really about tax anymore. We talk about all those other positives with working with Guernsey structures and Guernsey advisors. Nick, on the previous panel, we also discussed contentious disputes between families. Do the differing positions of family members impact the investment of their holdings?
Yeah, the short answer is it can do. Obviously, the best solution is where, and the previous panel touched on this, is where you have some sort of governance structure where the family members agree around an investment philosophy, and then it's much easier for an investment advisor to implement across an agreed philosophy. But the main areas of contention, unsurprisingly, probably are cash distributions to younger members of the family, liquidity and risk tolerances. Again, that can change generation to generation. And then thematic investing, we touched on it previously, but to generalize, some of the younger generations are perhaps more engaged in kind of environmental and socially themed, investment opportunities. I would say it's probably easier. The bigger you are, the easier it is to come up with a solution, because ultimately, if it's difficult to agree amongst the family, you can segregate the mandate and have different mandates, and we can do that. We see that quite a bit. But ultimately, it's trying to build a consensus and then create that framework that I alluded to right at the start, which makes it easy. And that's a journey that can develop over time. The framework can develop a little bit as well. It's not set in stone just because you've agreed it at a date in time.
Maybe I could jump in there, because what we see, which I find it really fun to work with the next generation, because they want to look outside of just the investment mandate that they have with us. And because at JP Morgan, we have all of our lines of business now in the UK. It allows us the opportunity to work with them on direct investments. Many of them are entrepreneurs and want to start up, and they want to have support for their own businesses. So actually, I think it does open up a much broader range and a much deeper way of engaging with the whole family because of that next generation.
Thank you. Going back to structuring, and another question for David. We discussed on the previous panel the trends around the greater mobility of families, high net worth individuals in particular. How is this, along with the current economic outlook, impacting structuring in your experience?
Yeah, I mean, I think you need to make sure that the structures that our advisors are recommending can be portable from one jurisdiction to another, because there is, we're seeing increased global mobility all the time. There's, people leaving the UK to live in other parts of the world, people moving back to the UK, people relocating around with their jobs. high net worth families often have assets in different jurisdictions. They may have two different nationalities within the marriage as well, which increases sort of complications. So there needs to be portability in terms of the structures that are recommended. And again, I think Guernsey comes into its own here as well from an international perspective, because a lot of UK and other major economy providers and companies, they will build very good structures for the domestic market. They sometimes forget about that global portability and the fact that people do move around from one place to another. And I think what Guernsey's become very good at, and they've got there's two examples really, is providing products that can move from one jurisdiction to another. So I gave three examples. I gave the point about the fact that a lot of the Guernsey companies are subsidiaries of multinationals, so that's one. Secondly, on the pension side of things, Guernsey's able to pay pensions income tax neutrally, so it'll pay the income gross. They don't have to rely on double taxation conventions and that type of thing. And that means that the tax can then be paid depending on the taxation in the client's country of residence. And if the client then moves from one country to another, then the income continues to be paid gross and it's taxed appropriate in the new country of residence. So it's very portable from one country to another. And then the second point is a good example of where I think Guernsey has been very innovative is, and I think it was touched on in the last discussion, which is the difference between common law jurisdictions and civil law jurisdictions. And one example in pensions is that common law jurisdictions, such as the UK, recognise trusts and recognise how trusts work. And a lot of pensions are structured as trusts, and I referred to trustees earlier. But a lot of contract law jurisdictions in Europe, for example, civil law jurisdictions, they don't recognise trusts. And what Guernsey have done is produce contract-based versions of the pensions and other forms of structuring. They've produced contract-based versions so that they can be used and are recognised in European jurisdictions. And again, that allows that portability from one jurisdiction to another, because you've got something that can work in one jurisdiction, the client moves, they can work in another jurisdiction. This client's got assets in different jurisdictions, they can have different structures that are appropriate to each jurisdiction. So it's very portable for global mobility.
Such an important consideration. Turning back to trends, and in particular ESG and impact investing, which we've touched on a few of our topics. Diana, do you think the trend towards increased emphasis on ESG and impact investing, do you think that will wane with the economic downturn we've seen in recent times?
Well, it's interesting. I hate to have everyone on a panel agree, but I think we heard from it makes it more interesting if we disagree. But I think we just heard from the prior panel, right? The idea that ESG is something that will become more and more ingrained into every single aspect of what it means to manage wealth, not just on the investment side, but on every single part of the business. We talked a little bit about next generation and what their views were. I think their desire to have authenticity around everything that they do continues to drive that trend. So I think I'm not going to create a lot of controversy in answering that question.
And Nick, do you see the same thing?
Yeah, I mean,
Can you disagree?
Well, no, I wouldn't disagree, but I guess the only thing I'd add is I don't think it's economic related, so in terms of economic downturn or slowdown. I think it's actually many of the best financial returns today, I think, are driven by some of the themes that are ESG related. So the energy transition theme, and I'm thinking about climate technology, education, edtech. Trying to give much broader access to education globally. That's obviously a very socially driven theme, and I don't see clients investing it just because it's ESG anymore. I think it's they're wanting to invest in it because they can get a very decent financial return out of it. So I guess what I'm saying is you don't have to be ESG conscious to really be embracing some of the ESG themes. They're there because they're financially credible in their own right.
We talk about saying it's value versus values. Right. That there's actually a great investment opportunity.
Yeah. It can be very value driven by the family. I think it's very difficult to be impactful across environmental and social themes. So we often see families that have a particular passion in a particular area, and we would encourage them to embrace that passion and be quite focused about where they can be impactful. But so it goes beyond economic cyclicality. It's more driven by the opportunity set.
That's great news for trustees, as trustees are duty to preserve and enhance the value of the trust fund, and historically that potentially meant a trade-off if you either wanted to preserve and enhance, or the choice was ESG. But now it is both. You're still fulfilling trustee duties and
Yeah, I think it's gone
investing.
beyond, like, I don't think it's compromising returns anymore. We've gone beyond that. If you're looking for the best financial returns, it's probably in the private markets that are being the most disruptive in some of the themes that I just touched on.
Yeah. And finally, a question for all three of you, and we'll go in the order in which you're sitting. So Diana, David, and Nick. Please, can you just quickly let the audience know one trend to take away? What's one trend that they should all remember today?
So I'm going to
So-
come back to where I started, which is I think that the economic environment that we're in is really a regime shift, and inflation is no longer a one-way risk. It's really a two-way risk. And the implications that has for where people invest in the traditional 60-40 portfolio, we actually think you need to look beyond that. Particularly, real assets has a role to play, infrastructure, real estate. And if I could have a second one, it's just to encourage, there's a huge amount of cash sitting on the sidelines. I'm sure everyone's clients is lots and lots of cash, and people have been really reluctant to put cash to work. I'm pretty well convinced that if you were sitting here in any kind of time horizon that trustees look at, cash is not where your clients should be having their wealth at the moment.
David.
Yeah, I'm going to try and be controversial for Diana and make a
Thank
link
you.
between ESG and AI if I can. One of the things that providers sometimes say to me about ESG is, in a negative way, is that we're spending so much money now on complying with ESG and complying with other regulatory requirements. And as we said before, there's good reasons for all of the regulatory requirements to be in place, but they do drive costs up, and so there needs to be a balance, I think, between and I think the regulators need to be cognizant that if they are putting regulations which are driving costs up. A lot of big providers have, for example, a big ESG department now, and they're having to employ people and pay people to make sure that the company is compliant with ESG requirements and ESG regulations, and they're not greenwashing and all the rest of it. And I think potentially the response to that in the future might be that we're going to make things more efficient. So we talked about Diana and I were talking about there's been consolidation because smaller providers can't meet these costs, so the smaller providers might merge together and consolidate so that they're able to meet those costs, and that can be a good thing, but also it can reduce the choice available to people. It can reduce the competition, the competitive element of it, and then how do you drive costs down? Well, you might introduce a call centre. I have a pet hate of call centres. But I think a lot of high net worth individuals need to be dealing with people, and they want to deal with people, but there's a cost to that, and that's why the bigger corporations bring call centres into place. And then sort of finally to go on to AI, I think AI is growing massively. Amazon have just invested, I think it was £4 or £6 billion, several billion pounds, buying a competitor to ChatGPT. So that, they're obviously taking it very seriously, and it's going to increase massively over the next couple of years. And one of the ways in which providers can bring costs down is to use AI, which again is great, but it's got to be harnessed in the right way, I think. And where I'd caution on that is to say that high net worth individuals, I think, and high net worth families are going to always want that personal contact. That does bring a certain element of cost. And is there a threat to that personal contact from increasing regulation, which the regulators would not be doing deliberately, but it might be an effect of the increased regulation. If costs go up, efficiencies need to be driven, and therefore does it become less personalised? I don't know what anyone else thinks about that point, but is that controversial, Diana?
I don't think it's controversial that at the end of the day, ultra high net worth clients are always going to be very keen on having a personal advisor. Yeah. Never taken away enhanced by AI, but not replaced.
And final words, Nick, on trends.
Yeah, I mean, the final word, if I had to sum it up in one word, would be disruption. You know, I think we need to be, I'm continually trying to remind myself just how quickly the world is evolving and how disrupted we are already being. I mean, who would have thought 20 years ago that we'd have self-driving cars, going around San Francisco right now today? Who'd have thought we'd have, private companies putting people into space? I went to a Tim Peake, the astronaut Tim Peake conversation last week. Did you know that we can 3D print human organs in space today? And we can't do it in down here because gravity collapses them, but in space we're already doing that, and some of the amazing stuff that these astronauts are doing. So this will directly impact all of our worlds much more quickly than we think it is, and I think we should embrace the theme of disruption in everything we do.
Thank you. So just before we break for afternoon tea, if you could thank the second panel in the usual way, please. Thank you.